Thank you for joining us on today's episode of Tax Matters. Brand new week, brand new episode. And talking about a brand new episode, so many things are jostling for space on the program. Recall that last episode, our focus was on Nigeria's national tax policy, which, like other such policies, is the foundation for tax legislations and, of course, the third pillar, tax administration. Now, we have a story of a training conference for all cadres of senior justices, Supreme Court justices, and justices of the Court of Appeal, as well as judges of the Federal High Court and the National Industrial Court, organized by the National Judicial Institute. It was on the role of the judiciary in the enforcement of tax laws. And of course, when you talk about laws, the Petroleum Industry Act, PIA, is the latest law in the realm of taxation coming out of the National Assembly. We also have a story on that. Both stories are loading. But you see, like they say, when trees fall upon trees, you take out the one on top. On Thursday, the 7th of October 2021, President Muhammadu Buhari presented the 2022 federal government budget proposal to a joint session of the National Assembly. On today's episode, we are going to be sharing with you the tax components of that presentation, and we'll be doing the same on the budget breakdown presentation made by the Honorable Federal Minister of Finance, Budget and National Planning on the following day, Friday, the 8th of October. But before then, news from Revenue House, Abuja. A public notice issued under the hand of Muhammad Nami, Executive Chairman FRS, is asking taxpayers to conclude all processes of reconciliation and submission of their Naira-denominated companies' income tax returns for 2021 year of assessment on Tax Pro Max on or before 30th of November 2021. It will be recalled that the FRS introduced the Tax Pro Max, a solution for the filing and payment of all Naira-denominated taxes, and made it mandatory in June 2021 with the sole aim of reducing costs of tax compliance and enhancing ease of doing business in Nigeria. In order to support seamless migration to Tax Pro Max, the service suspended the imposition of late returns penalty and interest on companies' income tax returns for 2021 year of assessment, which were due for filing on or before 30th June 2021. This was to give room for taxpayers to reconcile their respective tax accounts, including withholding tax credit notes for effective onboarding to Tax Pro Max. Now, the FRS is asking taxpayers that are yet to finalize filing of their company's income tax returns for 2021 year of assessment, including outstanding back years on Tax Pro Max, to seize this opportunity to do so immediately to avoid penalty and interest on late filing after 30th November 2021. Any company's income tax returns for 2021 year of assessment not submitted within this grace period will be subject to late returns penalties and interest, with effect from the due date of such returns.
I'm a very busy man. My business involves a lot of traveling, and I interface with lots and lots of people and organizations. Tax compliance used to be a big drag on my business. It was time-consuming and very costly. But now, no more. Introducing the FIRS Tax Pro Max, the truly fully end-to-end tax administration solution for companies' income tax, value-added tax, petroleum profits tax, and all other tax types. For fast, efficient, and convenient end-to-end tax experience, log on to www.taxpromax.firs.gov.ng. Tax Pro Max has turned things around for me. It is fast, user-friendly, and cost-effective. FIRS, making tax administration as easy as ABC.
Welcome once again. On Thursday, the 7th of October, President Muhammadu Buhari was at the National Assembly to present the 2022 federal government budget to a joint session of the National Assembly, tagged Budget of Economic Growth and Sustainability. The 2022 appropriation bill contains a total budget estimate of 16.39 trillion naira and is predicated on certain parameters as spelled out in the 2022 to 2024 medium-term expenditure framework, MTEF.
The 2022 and 2024 medium-term expenditure framework and fiscal statutory paper set out the parameters for the 2022 budget as follows. A conservative oil price benchmark of 57 United States dollars per barrel. B, daily oil production estimate of 1.88 million barrels. C, exchange rate of 410 naira 15 kobo per United States dollar. And D, projected GDP growth rate of 4.2% and 13% inflation rate.
President Muhammadu Buhari also spoke about efforts being made by the federal government to increase Nigeria's tax to GDP ratio, as well as strengthen the framework for the road infrastructural tax credit scheme.
Our target over the medium term is to grow our revenue to GDP ratio from about 8% currently to 15% by 2025. In 2022, government will further strengthen the framework for concessions and public-private partnerships.
On strategies to improve revenue mobilization.
Our strategies to improve revenue mobilization will be sustained in 2022 with the goal of achieving the following objectives. A, enhance tax and excise revenue through policy reforms and tax administration measures. B, review the policy effectiveness of tax waivers and concessions. C, boost customs revenue through the e-customs and single window initiatives. And D, safeguard revenues from oil and gas sector.
And in continuation of the good work initiated by his administration with regard to regular review of tax legislations.
In line with our plan to accompany annual budget with finance bills, partly to support the realization of fiscal projections, current tax and fiscal laws are being reviewed to produce a draft finance bill. It is our intention that our ongoing consultations are completed. The finance bill would be submitted to the National Assembly to be considered alongside the 2022 appropriation bill.
The following day, the Honorable Federal Minister of Finance, Budget and National Planning presented the budget details at a well-attended press conference. On revenue projections.
The projected aggregate revenue available to fund the 2022 budget is 10.13 trillion. And this is inclusive of government-owned enterprises revenues. This revenue is 24.8% higher than the 2021 projection of 8.12 trillion. In aggregate, 34.9% of the projected revenues is to come from oil-related sources, while 65.1% is to be earned from non-oil sources. We also introduced in the budget the education tax of 306 billion, which previously was not being indicated as federal government revenue, but we are now showing it as a federal government revenue. And when we go to the expenditure side, you will also see it as a transfer. So it's a pass-through. But what it's doing is actually recognizing the revenues of government. And the dividend of 8.3 billion from the Bank of Industry is also being updated in the MTEF as an additional revenue line. The federal government share of oil royalty of 96.9 billion is expected to be transferred to the Nigeria Sovereign Investment Authority, the NSI, based on the provisions of the PIE. To further enhance independent revenue collection, Government aims to optimize the operational efficiencies and revenue generation focus of the government-owned enterprises. The introduction of new and further increases in existing pro-health taxes, for example, excise duties on carbonated drinks. This is work in progress, but it will happen in the 2021 Finance Act.
The program is Tax Matters, and so quite naturally, we are looking at Budget 2022 with special emphasis on the tax components. The budget breakdown session was an interactive one, and so questions, observations, and comments were taken from those in attendance, both physically and virtually. Mr. Ben Akabweze, Director General Budgets, and Muhammad Nami, Executive Chairman FRS, Chairman Joint Tax Board, responded to some observations.
I have a theory that the right discussion is an inconvenient one for most people, which is revenue, because the discussion about revenue, involves us. Everybody has to be involved. We all have to, up to the fact that, the option entail that we pay a lot more taxes than, just as happens in other parts. Our tax to GDP ratio is the lowest. There's no other way countries fund, public expenditure. Taxation is the principal way that we're paying too low taxes, and we're demanding, a lot in terms of public expenditure. So government's option is either not to provide, or in the interim, to borrow to provide while taking action to shore up the revenues.
From tax perspective, and from the figures we shared with the public last year, and if we are to be specific about what we are currently doing, you will discover that we're actually diversifying. One, the total collection we have up to 30th September, which we are even yet to fully reconcile with CBN and the Nigeria Custom, is about 4.2 trillion naira. And from this amount, oil-related taxes accounted for only 22%, which is 950 billion naira only. The non-oil taxes we have generated in the period is 3.3 trillion naira. So I want to believe the diversification is on course. Secondly, to discuss about the taxes that have been paid in this country and to say whether they are adequate or not, I want to believe, one, they are not adequate. People are not even willing to pay, even where people are appointed as agent of collection. Whatever they have collected on behalf of government, they find it difficult to remit. Number two, when you compare Nigeria as an oil-producing country to the small country of Saudi Arabia, like the Honorable Minister rightly pointed out, we are still not there. We assume that we're a rich country. I don't think that is correct. We only have potentials to be rich. Because one, we have very huge population, which is in the region of about 200 million people.
Still at the budget breakdown session, in responding to a question on why Nigerians are unwilling to pay taxes, the minister had this to say.
Ebuka raised the issue of the root cause why we are not paying taxes as Nigerians, that is largely distrust. That I understand that to mean that people don't see the benefit of the taxes that are being paid and therefore are hesitating to pay taxes. But while that is partly true, It is also true that people in Nigeria, we have got used to living as a rentier state. When we didn't have oil, taxes were the major source of funding government. And people, I remember even as a kid, there's the tax collectors that go around in villages to actually collect taxes, and people were responsible in paying taxes. But since we found oil and jettisoned most of the productive activities, especially agriculture, that we used to undertake in, and government now was at the center, was just providing money to the states, and we're still doing that on an ongoing basis. And once a citizen has not been paying their tax, then they themselves do not have the moral standing to actually ask for accountability from their from the government. But if you pay your tax, you will feel more compelled. You have a more compelling reason to actually ask for accountability. So we need to be able to go back to that period where we're all responsible citizens and we're paying our taxes. That's the only way we can grow on a sustainable basis.
I'm a very busy man. My business involves a lot of traveling and I interface with lots and lots of people and organizations. Tax compliance used to be a big drag on my business. It was time consuming and very costly. But now, no more. Introducing the FIRS Tax Pro Max, the truly fully end-to-end tax administration solution for companies' income tax, value-added tax, petroleum profits tax, and all other tax types. For fast, efficient, and convenient end-to-end tax experience, log on to www.taxpromax.firs.gov.ng. Tax Pro Max has turned things around for me. It is fast, user-friendly, and cost-effective. FIRS, making tax administration as easy as ABC.
You are still on to Tax Matters. On Friday, the 8th of October, news came in that 136 countries have signed up to an agreement that will make it mandatory for multinational enterprises operating around the world to pay corporation tax, otherwise known as companies' income tax in some jurisdictions, at a minimum rate of 15%. The agreement brokered by the OECD is coming after long-drawn discussions and negotiations. Put simply, it means that at long last, companies like Google, Facebook, Twitter, Amazon, Alibaba will now pay taxes where they operate. It is surely good news because this is at the very core of what countries like Nigeria have been asking for long. But wait a minute, 136 countries. That is not all the countries in the world, which means some countries are yet to sign. Nigeria is one of them. Why? 2 weeks ago, at the opening ceremony of the 10th year anniversary of the West African Tax Administration Forum and the High-Level Policy Dialogue, which was held in Abuja, the Honorable Federal Minister of Finance, Budget and National Planning spoke on this matter, and we did share with you what she said on that occasion.
We have actively participated in the global discourse around the issues of taxation of the digital economy, particularly as it affects the allocation of taxing rights. In this regard, we have continued to contribute our quota in different fora, most importantly in the OECD G20 Inclusive Framework on Base Erosion and Profit Shifting, otherwise known as the Inclusive Framework. Distinguished ladies and gentlemen, let me highlight that the basis of our involvement in that process was the understanding that a coordinated universal solution to tax challenges of the digital economy was necessary, and that the solution would be fair and acceptable for all members. We had hoped that all jurisdictions will be participating in the project on equal footing, and that the agreed solution will benefit all while preserving jurisdictions' existing taxing rights, which are not aimed at the digital business, and that the project would provide universal acceptable rules by consensus. The question therefore arises, why has Nigeria not endorsed the OECD proposed solution to the issues affecting the digital economy? Simply put, Nigeria seeks to prioritize the importance of securing a fair deal that provides for equitable global reallocation of profits from all markets and from all jurisdictions, and it is our view that the agreement has not met this objective. I crave your indulgence to highlight one or two implications of the proposed solution for us. First of all, the scope of the Pillar 1 covers only multinational enterprises, M&As, with 20 billion euros global revenue and above 10% profitability, which means just about 100 companies across the world are within the scope of these rules. This threshold has left many of the well-known M&As exploiting the digital space out of the scope of Pillar 1 and significantly reduce any benefit that may accrue to market jurisdictions from Amount A taxing rights. Even where the non-resident companies meet the revenue and profitability threshold, there is still the requirement of operating in and meeting local sales threshold of 1 million euros in the market jurisdiction, except for jurisdictions that have a GDP of $40 million and below, that have the in-scope revenue threshold fixed at 250,000 euros. Furthermore, the proposed scope reduction after 7 years of implementation provides for some conditions which include effective implementation of mandatory binding dispute resolution mechanism. Thus, there is no certainty of the reduction in the scope threshold, and the rule may continue to apply to only the few countries that fall under the scope revenue and profitability thresholds. One other critical issue is that the project introduces a mandatory binding dispute resolution mechanism for Amounts A and issues connecting to it, including all transfer pricing and business profit disputes, which implies that most tax disputes involving multinational enterprises cannot be determined under domestic legal framework, but under international arbitration. This will most likely lead to conflict with the requirements of domestic laws for many jurisdictions.
Issues raised by the Honorable Minister in her address came up during one of the panel sessions.
We have issues around fairness and equity in the proposal, which we believe that is skewed against developing countries. Two is the potential for it to generate negative tax returns to countries that would sign up, particularly from developing countries. You may find out that you will lose more than what you stand to gain from Amount A. Another reason is that, for example, in Nigeria, we have constitutional reasons. Our law specifically states that government revenue can only be determined by the Federal High Court in Nigeria, not in any other arbitrary process. And of course, we have issues around the definition of unilateral measures, which we believe is encroaching into the traditional taxing rights of Nigeria.
Until Nigeria is convinced that the deal is a good deal, we will not sign. That's sovereignty for you. That's national pride. That's a country that knows what she wants. Tax Matters will keep you posted as events unfold. Go out there, be a proud Nigerian. Be a good Nigerian. Pay your taxes as and when due and ask for your rights. See you next week.